Hello, everybody. I am Luis Curi, and it's a pleasure to be here with you today. It's also a pleasure to have here Mr. Sébastien Page. He is the head of the Global Multi-Asset Division in Rowe Price. Sébastien has over 20 years of investment experience, and he's a member of the Asset Allocation Committee and of the Management Committee of Rowe Price Group. Prior to this, Sébastien was employed as an executive vice president at PIMCO, and he was a senior managing director at State Street Global Markets. Sébastien won a research paper awards from the Journal of Portfolio Management in 2003, 2010, and 2011, and from the Financial Analyst Journal in 2010 and 2014. He's the author of the book Beyond Diversification, was published in 2020, and a co-author of the book Factor Investing and Asset Allocation that was published by the CFA Institute Research Foundation in 2016. Sébastien also is a member of the editorial board of the Financial Analyst Journal and of the research committee of the Institute for Quantitative Research in Finance from the Q Group. He frequently appears on financial media, including Bloomberg TV and CNBC. Sébastien earned his degree in business administration and in finance from the Université de Sherbrooke, and he also earned a chartered financial analyst designation. Sébastien, welcome, and it's a pleasure to have you here today.
Thank you, Luis. Likewise, very excited to participate here today.
Thank you very much. And if you may, we can start by discussing and asking you several things and having your experience and sharing your points of views on different topics. But I would like to focus on your view and your experience on portfolio construction and different other topics that impact the Mexican specific Afore industry. We know that your target date strategic design has led to strong outcomes over the long term because, in part, a balanced view of the myriad risk factors, both short and long term, that impact the retirement of investors. Which do you think are the most important risk factors to be considered in the design of a target date strategy, Sébastien?
So we all talk about market risk, the risk of losing money in the markets, but there are more risk factors. One of the hardest parts of our job is managing the different and sometimes, Luis, conflicting risk retirement savers are saving. And so let me give you the punchline. It's not as simple as just mitigating market risk. You have longevity risk. So that's the risk of running out of money in retirement. You know, Luis, people tend to live longer. That's a good thing. Let's just remember that. But it means we need to make their money last longer. Then there's inflation risk, the risk that your standard of living will decline over time because of rising prices. And this is a hot topic right now as we're speaking. Now, these are really impactful risks if you want a successful retirement. But let me ask you, Luis, people in our audience, a rhetorical question. What is your goal for retirement? What exactly are you trying to achieve? How much money do you think you need in order to be able to retire? So we believe the goal for retirement is basically having enough money to live well over a long retirement. This means you can maintain your pre-retirement standard of living, right? So you don't want to have to cut back without running out of money late in retirement. Market risk is easier for investors to understand. It's tangible, right? We see it. Longevity, inflation risks are harder concepts, but both can be catastrophic to a successful retirement when you actually feel their impact, because it's often too late to do anything when you feel the impact of longevity risk, meaning, oops, I've run out of money, or of inflation, meaning my purchasing power has almost disappeared. You need to plan ahead for these risks. Once you run out of money, you can't go back and spend less. or you can't invest in a different way. It's the same for inflation. Whereas market risk, there are actions investors can take along the way. Steps like delaying retirement a little, 6 to 12 months, slightly reducing your spending, can ensure market risk doesn't jeopardize your long-term retirement plan. How long do you think you'll live, Louis? Is that a hard question to ask? We don't really know, right? Let's look at Mexico. Longevity in Mexico has flatlined, and it's even come down a bit, but it's about 75 years old on average. This is almost 5 years longer than it was a generation ago. So people tend to underestimate this risk. They also tend to underestimate inflation risk. So here's an example. Suppose we get 3% increase in inflation each year, 3% inflation. Well, you need 143% more income 30 years from now compared to today to keep your same level of spending. So the punchline, Louis, here is just 3% inflation over 30 years means that 30 years from now, you need a lot more money to buy the same thing. And by the way, the inflation rate in Mexico right now is running at close to 5%. In the US, we just had a print at 6.2%. What makes the problem so hard is these risks are competing. This is the key, Louis. They're competing in the sense that the more you focus on combating one risk, the greater it makes the other risk. The more you work to limit market risk, for example, say you want to be super conservative with your retirement savings. Well, the more you increase longevity and inflation risk, because the only way to accumulate enough money to last longer is to invest in stocks, not bonds. While market risk is important, and we spend a lot of time thinking about strategies to mitigate it, we need to make sure those strategies and our focus on limiting market risk doesn't come at the expense of a longer time, longer horizon rate of return. The ultimate goal of supporting long, successful retirements, accounting for longevity and inflation risk. So the bottom line is you probably need a higher stock allocation than you think. In our glide path, in our target date funds, at 50 years old, we are at, if you're 50 years old, so you're about 15 years from retirement, right? You're at about 85% stocks. And I know that the target date fund glide paths in Mexico are at a lower stock level, which is why I wanted to bring this up, Louis. We're at 55% at retirement. I'm 44 years old. I'm not going to retire for a while. I'm at around 90% stocks in my own portfolio. So, Louis, the bottom line is we have to think about all these risks. And if you only try to mitigate market risk, you don't get the same compounding for your savings that will make your money last longer and help combat inflation.
I mean, you're totally right, Sebastian. We need to deal with several balls in the air while we construct a strategy. And you're right also about Mexico. One of our biggest challenges is obviously longevity, the diversification of our portfolios, and also the way we are actually contributing to our pension plans. That's another different thing. We are changing that already, but several challenges we have in front of us. Obviously, inflation is one of them as well. And talking about this specific topic, as T. Rowe Price, do you believe that retirement investors should remain focused on their long-term goals? What is your opinion on the long-term view of the target date funds? Because it's sometimes tricky. We tend to look at short-term returns. We are very on the quick returns of our portfolios. But what should be the view of investors regarding the target date funds, Sebastian?
So great question, Luis. And here's my own example. I mentioned I'm 44, so I won't retire for another 15, 20 years. But once I retire, I'll need my money to last another 25 plus years, hopefully, if I stay healthy. We believe investors should take advantage of this long time horizon. Very early in the US retirement market, in our own market, target date strategies were very conservative because they were focused on shorter term outcomes, limiting short term market volatility. We were really the first to recognize that target date strategies should be built for the long term. I was told, Luis, over 50% of investors in Afore are between 25 and 45 years old. So your investors, about at least half of them, still have a very long time until they retire and should take advantage of this long time horizon. In addition to thinking about longevity and inflation risk, which we were just thinking about and talking about, Mexican investors are I'm told, and heard that from you, Luis, as well, and others, aren't saving enough. I think you mentioned 6% of their salary.
6.5 actually.
6.5, which means
right.
you know, if you're only saving 6%, you need your investments to work harder for you, right? You need a high return to make compounding work for you over time. So for these smaller contributions. And you know, rates are higher in Mexico than in the U.S., right? They're definitely higher in the U.S. They're approaching zero. But the fact that rates are really low after inflation really means that you need a rate of compounding somewhere else than in the U.S. than in Treasury bonds. So we recommend saving 15% a year for those who are able to, for someone's entire career. These factors influence our belief that target date funds should take a long-term view and allocate more to stocks and other asset classes that can deliver more growth over someone's career. Investors need the growth. We have the time horizon to withstand the market's ups and downs. And also, Luis, you're not putting all the money in one moment, right? You're putting the money over time at different market levels, which also mitigates your timing risk. And investors should therefore ultimately benefit by the time they retire.
Totally agree. And let me share with you, and you know, Sebastian, the good news is that with the a new regulation that it's in place beginning this 2021, we are going to begin increasing the contribution rate, and we go up through 15% actually, which is more aligned to international standards. It would take us time. We will do that in the next following 8 years, but that's a good part. And as you mentioned, we still have a broad base of young affiliates in the country, and that's a good news. We still have time for them to increase their contributions, their savings, and get the appropriate, let's say, returns for them to have a decent and a reasonable pension in the future. We're working on it, and I think it's a very positive situation for our industry. Talking about specifically the target date funds, Sebastian, and I would like I'd love to listen to your thoughts on these. Some experts have highlighted that there is a necessity to revisit some details of the target date funds, like mixing active and passive investing strategy to enhance risk-adjusted returns and manage costs, and calibrating the glide path to deliver better results in the distribution phase of our retirement plan. What do you think about this? In your opinion, what are the main challenges and opportunities for the future of target date funds? In Mexico, as you know, we are very new to target date funds. We also believe it was a very important positive change in the way we manage the investments in Mexico. But what's your view on the future? What do you think about it?
We believe all target date funds should have some level of skilled active management. Skilled active management can really impact outcomes, can really impact the returns you're getting. Look for active managers that focus on the long term, have a repeatable process, and invest massively in investment research. I know one, Luis, but I can't name them. Otherwise, you'll tell me that I'm selling. So let's just say that the name starts with T, and it rhymes with Rowe Price. Our oldest family of target date strategies have outperformed their passive benchmarks 96% of all rolling 5-year periods going all the way back to 2002 and have averaged 1% extra return over those rolling 5 years. That outperformance has resulted, obviously, in higher balances for those that are approaching retirement by as much as 20-25% higher balances. And by the way, even as little as 0.25% or 0.5% in excess returns over long periods of time can lead to very big differences in retirement savings and ultimately additional years of income in retirement, helping with the longevity risk we were just talking about. Active management is going to be even more important as returns on stocks and bonds are, it's sad to say, but are likely to be much lower than we've seen over the last 20 years, given where rates are. Ultimately, we think there can be a place for both active and passive strategies. Luis, I just published an article on my LinkedIn channel. This is an article about active management. I explain how the goal of active management is to give people better retirements and how important active management is to allocating resources in the economy. Ultimately, you have to think about this. You can't have passive management without active managers to set prices. And the title of the note, Luis, is, and this is a true story, my friend called my profession BS, and I don't know how this will translate, but this is the title on the LinkedIn article. If you don't follow me on LinkedIn, please find me there. I only have a few followers, so I'm looking to grow our digital marketing space.
Count with that, Sebastian. I'll do it right away after this session.
Thank you. And so how's that for self-promotional? But the broad ideas around active and the importance of skilled, not just any, skilled active management in leading to bigger pots of money by the time you retire. It's all explained in there. It's a little bit philosophical as well. So I'd invite people to read it.
No, sounds great. And actually, seriously, I'll look at it right away. It's the reality we are facing right now, and we need to really think about it. In Mexico, we are still one step behind what you have in the U.S. and or other developed markets, but we are going there. I think that we are moving there. We are trying to diversify our portfolios and slowly moving to more active management of our portfolios, and hopefully that will eventually help our affiliates to earn a better pension in the future. I know, and I mentioned at the beginning of our session that you are very active in the news, and as you mentioned, writing articles, but also you published last year your book Beyond Diversification, what every investor needs to know about asset allocation. Very interesting book that was released that last year, and this year the central topic of this event is actually the future. So I feel compelled to ask you the following question: how do you imagine the future of methodologies, tools, and asset allocation itself? What's your view on that regards?
Great question. And I know the theme of your conference is 2050. So we're talking about very long time horizon. In my book, I talk about how computer-based models can be combined with human judgment to make better investment decisions. I think of the balance of man or woman versus machine and how it will continue to evolve. There will always be a need for human judgment because financial prices are set by humans. But the balance between computer-based models and investor judgment will evolve and will look different in 2050, if that's the question you're asking. As for target date funds, the future will be in personalization and retirement income. The decumulation phase. What do you do with your investment portfolio once you retire? This will require technology, especially the personalization phase. We're seeing the opportunity for more personalized asset allocations as investors get close to retirement, as we gain access to more data on investors. We know their age or the year at which they were born, but we can gather more data to get more personalization. And this is a trend that is likely to grow in the long run, probably before 2050. We'll be using also big data and artificial intelligence to better personalize the retirement savings accumulation and income decumulation experience for the individual. I also think our industry needs to find more technology solutions to help you save. And there are different ways of doing that by learning how you spend, basically perhaps on data from your banking account, user-friendly applications that are focused on saving rather than trading. I'd rather see technology deployed to help people save more effectively than have them trade day to day.
Agree. By nature, I think humans, we don't have the habit of saving, actually. So we need to find innovative ways to ask people or to move people to save. And I agree. I mean, technology in the future, actually right now, it's changing the way we manage our money and the way we connect and we transact. So it's going to be very important. I want to talk a little bit about Mexico, Sebastian. We mentioned earlier the challenges we have, obviously one of them being the contribution rate, which we mentioned already that it's going to increase in the future, talking about specifically pensions. But another clear problem we have, and I mentioned that earlier, it's that the Mexican working population is the existing labor dynamics. I mean, we have a problem there. We have, a lot of workers, a lot of people going in and out of employment, which does not offer them wage stability. What do you think? What's your opinion on this? What kind of alternatives do you think the future could offer to this currently unattended sector in your experience? What can you share with us?
Yeah, this is a tough one, Luis. It's really a savings question more than an investment question. In other words, you can't invest your way out of a savings problem. However, you can, of course, consider your savings and how you invest. And we've talked about this a little bit. This might be counterintuitive, but you want the money that workers are able to save to grow as much as possible and not to be invested too conservatively if the investment horizon is long enough, if these are retirement savings. Luis, we have a big problem in the US, and it's kind of the same in most parts of the world. Interest rates, after you remove inflation, they're basically zero or even negative. And so that makes accumulating money, your pot of money for retirement, very hard. And that's why it's a savings problem more than an investing problem. Imagine, Luis, that your money doesn't compound at all. And you have this idea that you're not going to gamble with your retirement money, and therefore you're only going to invest in very safe. In the US, it would be treasury bonds, government bonds. Well, after the inflation, you're going to get zero compounding. Suppose we were talking about 6.5% savings in Mexico, you're going to 15, which exactly matches our recommendation. Suppose you save 10% a year and you get zero compounding because you're playing it safe. And basically right now in the US, at least, real interest rates after inflation are zero. Well, in order to accumulate 1 year of retirement income, 1 year of spending in retirement, if you don't get compounding, the math is such that you need to save 10% of your salary for 10 years. 10% for 10 years to accumulate 1 year of salary replacement. Think about the math, Luis. 10 to 1. You will never accumulate the wealth you need to retire if you get zero compounding. I think that's a good note to end my comment on that.
No, that's great, and you're totally right. I mean, the majority of people, the majority of the affiliates, the workers, don't know this, and we need to help them with that, and we need to expand our capabilities, to diversify our investments and the asset allocation in order to provide that additional alpha that it's needed. Because as you mentioned earlier, even as 0.5% or 0.25% in the long run, in 25, 30 years, will make the difference. And that's actually our major responsibility as asset managers of the mandatory pensions in this country. Talking about markets, let me ask you something, and you're very familiar with markets. When market sentiment turns negative and fear grip markets, government bonds almost always rally because of the flight to safety effects. In this sense, is the stock bond correlation the only true of diversification, or what's your view on that?
This is a really good question, Luis, and it's very important to asset allocation. Typically, you're correct in the question that when stocks sell off, safer bonds like US Treasuries or government bonds generally tend to do well, and they hedge your risk. They reduce the risk of large losses in your portfolio. There are two problems right now that make this less likely going forward, and that will diminish the role of bonds going forward. The first problem is inflation and interest rate uncertainty. When we get a growth-led shock, a recession, bonds will rally, stocks will do badly, you'll get your diversification. If we get a taper tantrum or an unexpected interest rate hike or a shock in inflation that's unexpected, then both stocks and bonds can go down together. So you lose the diversification you get from safer bonds. So that's a problem. The other problem is that when bonds approach the zero bound, close to zero rate after inflation, it's much harder for those assets, for those bonds to rally, because the way bond math works is that when rates go down, bond prices go up. But if rates are close to the bottom and can't go down, that means bond prices can't go up anymore. And if you look at what happened to German bonds, German government bonds around the COVID crisis, long US Treasuries during the COVID sell-off in the first quarter of 2021, they were up 20%. They really protected your portfolio.
Right.
The German bonds, even the long ones, the long horizon ones, were basically flat. And you know what happened to Japanese government bonds, JGBs? They were a little bit down. Exactly. So yes, you'll preserve some of the money, but you won't get the same hedge that you had historically from interest rates. So what does it mean for asset allocators? It means we need to rethink diversification. We need to find new sources of diversification, better sources of diversification. Active management can help. Absolute return strategies can help. Commodities-like assets can help. There are different ways to restructure the portfolio to help mitigate the impotence of bonds going forward.
Totally agree. As we say in Mexico, I don't know if in the US it's the same saying, but you can put all the eggs in the same basket, because eventually, yeah, that will not work. And diversification is the name of the game. Obviously, with what have we discussed with a long-term view and taking into consideration not only inflation or rates, but all of what it's related to pensions. Sebastian, we ran out of time. It's been a real pleasure to have you here and to listen to your thoughts and your inputs. And we really appreciate your contribution to this session and to the Afore convention we are having right now. Thank you very much.
Thank you, Luis. Thank you for inviting me.
It's a pleasure to have you here. Bye-bye.
Thank you.